Hello, this is Mijun from Mijuran University. Let's begin today's Bigju City News for July 22nd. Welcome once again to Mijun, where we continue to uphold the fundamentals of United States stock investing. Mijun family, it's been a while since I last greeted you. Since I took a break from broadcasting yesterday, I'm bringing you the first broadcast of the week on Tuesday. I apologize for taking a day off due to personal reasons and ask for your understanding. Today as well, I think I should start by responding to a comment left by one of our valued subscribers. I've actually shared my thoughts on this question several times before, but the same question keeps coming up from various subscribers. So let me explain it once again this time. This is a comment left by Mr. Kenneth Lee. Thank you for the very informative content today as well. It seems like there's now a Q&A section, so I'd like to ask a question as well. You mentioned that when increasing your cash position, it's best to sell the stock with the weakest momentum. If I bought that stock at a relatively high price and it's currently at a loss, should I still sell it to increase my cash position? For example, if I were to sell Tesla today based on the momentum criteria of Mijun's top picks, I might feel reluctant to sell if I bought it at a higher price than it is now and I'm currently at a loss. On the other hand, if I'm making a profit with Nvidia, I might want to reduce my Nvidia holdings and increase my cash position. In this case, I'm curious about what I should do. Since Mijunim said he doesn't look at individual stock returns, does that mean he just sells according to the current momentum, even if it means cutting losses without worrying about these concerns? I'm not sure if I understood correctly. Yes, you understood it correctly. First of all, the most important thing is you gave examples with Tesla and Nvidia. The standard for selling and buying shouldn't be the profit rate I have, because the profit rate I have it has nothing to do with the fundamentals of this company. It's just that when I bought this stock determines my average purchase price, and my profit rate comes from that average price. So since my Tesla return is negative right now, I shouldn't sell it. And since my Nvidia return is positive, it's okay to sell this one. This doesn't make sense logically. So the most important thing is to completely ignore your average purchase price or the return you have on a particular stock. That's what I want to emphasize. And there's one more basic message I'd like to share. We need to pause for a moment and think about why we keep buying more of stocks with good momentum and keep reducing our positions in stocks where the momentum is declining. The most important reason is this. In my opinion, let's say we studied and analyzed really hard and bought about 20 stocks that seemed the best to us. But among these 20 stocks, there are some whose prices keep falling. In that case, you need to keep reducing your position in those stocks, and even if you eventually have to cut your losses and remove them completely from your portfolio, the reason is that there's a high chance these stocks will just keep dropping endlessly. The important thing is to identify early on any stocks in your portfolio that could cause you significant losses and remove them from your portfolio. I want to say that this is the most important and main goal. But the thing is, we don't really know when the stock market will go up or down. So if you just sell, the money you invested in that stock might end up just sitting there and not being invested in another stock. If that happens, it could get in the way of maximizing your returns. So when you sell stocks that have lost momentum and use the newly available funds to buy more of the stocks that are currently rising the most, I believe there's a high chance you'll achieve healthy returns. If you end up holding as many as 20 stocks, some of them could become stand beggars. However, some of these stocks will continue to drop by 70%, 80%, or even more. Therefore, what we shouldn't overlook here is that my choice could be wrong, so we need to leave room for the possibility of failure. If you want to avoid taking a big loss when you fail, the safest thing to do is to sell when the stock drops by 10% or 20% to prevent it from falling any further. Of course, sometimes the fundamentals improve again as the stock rebounds. At that time, there's a possibility that you might buy the stock again at a price even higher than the one you sold it for. But I believe that doing so is the safest and most reliable way for us to reduce risk and achieve healthy returns. This question isn't just from Kenneth Lee, it's actually a question that many people keep asking everywhere. And as many as 23 subscribers have liked it. So, since there are so many people who have concerns about this question, I decided to explain it in detail once again today. All right, then let's get started with today's Big Justin news prepared for July 22nd. Today as well, let's start by going over the market conditions of the United States stock market from yesterday. Monday's market, as you could see at a glance, was mixed. Half of the indexes were in red and the other half were in green. The good news is that the mega tech companies we care about are mostly in green. Amazon was up 1.4, Google was up 2.7, Meta was up 1.23, and Apple also went up a bit. Microsoft was flat, so overall, the mood for mega tech companies wasn't bad. In my opinion, the stocks listed here will soon announce their earnings results, and there are positive expectations for this round of earnings. That's how I interpret it. There is one reason for this. The reason investors are expecting positive earnings from mega tech companies this time is the weak dollar. The chart you're looking at now is the United States dollar index. The dollar index has been continuously declining since 2025. When the dollar drops like this, it's a huge benefit for global companies, especially those based in the United States. That's because overseas sales are converted into dollars. So the revenue collected from around the world is reported in United States dollars, and since the dollar has kept falling like this, there's a higher chance that the earnings results will be a bit more positive. Personally, I think this is also playing a part. Next is the market breadth. It's 61 and 15. So it's dropped a bit compared to last week, but the market breadth hasn't completely deteriorated. More than 61% of stocks are still maintaining a positive short-term trend, and stocks with a good long-term trend are hardly moving out of this category, still staying around 56 to 77%. When this figure goes over 60%, it's a very positive market. However, it's just not able to surpass the 60 mark. Therefore, stocks with a good long-term trend are still very limited at this point. It's hovering around 56%, 57%, and 58%. Next is the fear index. The fear index is very stable, staying at 16.65. So, it can be concluded that the Goldilocks scenario is still valid for now, and this trend has been continuing for over a month or two. There's not much change in the fear and greed index either. It's 73 last week, it was 74 or 75. You can see that there hasn't been a dramatic change in the market's atmosphere. Next, the market score provided by Choice Stock is pointing to 82. So there's a lot of greed right now. What that means is there are a lot of stocks with good price trends right now. And another thing is, it seems that a lot of funds have moved around. Recently, not only the leading blue chip stocks in the United States, but also smaller stocks have been continuously receiving investment funds. So it seems we can conclude that the number of stocks showing an upward trend has increased significantly. Earlier, there wasn't much change in the market breadth of the S&P 500, but what this current trend shows is that the S&P 500 is an index made up of large cap stocks, and the greed index shown here indicates that investment funds are being spread evenly across the 6,000 stocks listed on the United States stock market. There are also a lot of bets being placed on small cap stocks. That's how I can wrap this up. Next is the performance of Mijuon's top picks. First of all, the number of Mijuon's top picks has decreased from 21 stocks to 20 stocks. One stock has been eliminated. Let me show you which one it is. It's Nextracker. Nextracker stock has actually surged by 68.4% just in 2025 alone, making it a very rewarding stock. It's been a real star performer. But this time I boldly decided to take my profits. The reason is that there's a negative factor that could change the fundamentals. As you all know well, the Trump administration is drastically cutting support for clean energy. Therefore, if you look at it in the long term, over 5, 10, or even 20 years, Nextracker is an amazing company with outstanding growth potential. However, even so, President Trump could still have influence for the next 2 or 3 years. Therefore, I personally judge that during this period, its growth is less likely to stand out compared to other stocks. Besides, I also added another clean energy stock. Since I'm currently investing in First Solar, I personally thought it would be better to reduce my clean energy holdings a bit. I hope you can keep this in mind. Anyway, out of the 20 stocks, quite a few of them went up yesterday as well. Alphabet performed the best, rising 2.72% for the first time in a while. In the case of Alphabet, just like Amazon, its stock performance among recent artificial intelligence beneficiaries hasn't been that great. Therefore, if there is a surprise in earnings, a rise in the stock price can be expected. That's why we're seeing a positive trend right now. Cred Technologies is up 2.43%. Celestica is up 1.81%. Broadcom is up 1.72%, and PerSolar has additionally risen by 1.41%. As a result, PerSolar is showing a strong trend, having surged more than 10% in just 1 week. Next, Amazon is up 1.40%. Meta is up 1.23%, and Bitcoin has risen by 0.79%. Strategy is up 0.72%. Uber is up 0.63%, and AMD also showed a slight increase of 0.01%. All the remaining stocks are in the red, and Trade Desk has dropped by 0.2%. Tesla negative 0.35%, Nvidia negative 0.60%, TSMC negative 0.64%, B negative 2.06%, Palantir negative 1.13%, Coinbase negative 1.47%, and Vistra negative 2.48%. Lastly, Talon Energy's stock price had surged significantly. After the sharp rise on Friday, it underwent a technical correction on Monday and recorded a 5.63% decline. In my case, if Talon Energy drops a bit further, there's a possibility that I will buy it again. As I mentioned on the broadcast on Friday, I trimmed about 24% of my total holdings. But after that, there was a very big positive event, and thanks to that, the stock price surged. Now it's going through a technical correction. The fundamentals have actually improved a lot compared to before, and there's a possibility that sales could surge by nearly 50%. So if the fundamentals have gone up this much but the stock price drops further, at that point I personally think it's time to scoop it up. July has already entered the second half of the year. Today is July 22nd. Let me briefly reintroduce the 2 articles I shared with you at the beginning of July. This is content I also introduced to you on my broadcast on July 5th. The article was titled, United States Stocks Have Hit an All-Time High. Is it time to sell now? Let me just check one thing from this article before we move on. If you look here, it says, don't fear all-time high. Don't be afraid of all-time highs. There are 2 graphs here. The blue here represents buying the S&P 500 when it hits an all-time high, and the gray next to it represents buying stocks during periods that are not all-time highs. Then it compares the returns afterward. Now here's the fascinating part. When you buy stocks at their all-time highs, the returns are actually higher. After 1 year, the average return is 9.4%, which is actually higher than the average return of 9.1%. And after 3 years, the average return over 3 years reaches to 9.1%. And for the rest of the periods that hit all-time highs, it's only 27.3%. And when you bought stocks at an all-time high, the average return after 5 years is over 50%. Therefore, the conclusion back then was that it's actually more beneficial to buy stocks at an all-time high rather than sell them. And there was one more article which I shared with you on July 7th. The United States stock market has shifted from panic mode to a Goldilocks scenario. But we're really curious about how long this trend will last. I also showed you a chart related to this. Now, if you look here, over 50 days, the United States stock market saw a tremendous rise. To give you an idea of how much it went up, from April 8th, when the United States stock market hit its bottom, over the next 50 days, it surged by a whopping 19.8%. That's incredible. In just a month and a half, the United States stock market went up by nearly 20%. So, it's easy for many people to feel like they should sell their stocks, thinking the market has gone up too fast and too much. But if you look at historical statistics, after such a strong 50-day rally, there are records showing impressive additional gains over the next 3 months, 6 months, and even 12 months. After 3 months, the S&P 500 goes up by an average of 6.4%. Historical data since 1950 shows that the United States stock market has risen by 10.5% after 6 months and 16.4% after 12 months on average. Therefore, a sharp rise in stock prices over a short period is actually a positive signal, not a negative one. That's the conclusion we can draw. And in fact, stock prices kept rising in July, so this historical statistic turned out to be quite accurate. Now, since the market surged so much throughout July, United States stocks have actually become more expensive than they were during the dot-com bubble. I came across a very negative article, but it's actually not as negative as you might think. Let's read it together. History doesn't repeat itself, but it often rhymes. I completely agree with this part as well. Now, 25 years after the dot-com bubble, the question investors are asking is whether the past predicts the present. In other words, many investors are worried about what will happen if the dot-com bubble happens again. The stakes have undoubtedly gotten higher. From our perspective as investors, this is a very happy moment, but that also means the stakes have increased significantly. The Nasdaq index has continued to outperform the S&P 500 in terms of returns, even in 2025, amid the artificial intelligence boom that began in 2023. However, in the past, tech stock investors have experienced significant losses due to excessive enthusiasm. That's exactly what the dot-com bubble was, the dot-com bubble. After the collapse, it took the Nasdaq a whopping 15 years to recover its previous high. You can just see it as something terrible happened. Therefore, even tech stock bulls admit that the current performance of the Nasdaq is eerily similar to the late 1990s. Therefore, some strategists are sending out warnings that the market looks like a bubble. Now first, this is the opinion of Thorsten Slock, the chief economist at Apollo Global Management. The difference between the information technology bubble of the 1990s and today's artificial intelligence bubble is that the top 10 companies in today's S&P 500 are actually more overvalued than they were in the 1990s. In essence, he's asserting that the present artificial intelligence bubble is more severe than the 1990s information technology bubble. That's his current evaluation. He looked at the 12-month forward price-to-earnings ratio of the top 10 companies in the S&P 500 at the peak in the early 2000s. In other words, it's the forward PE ratio. We call it the forward PE ratio. How many times the expected net profit of a company over the next year needs to be multiplied to get the market capitalization. But right before the dot-com bubble burst, it is said that the forward PE ratio of the top 10 companies by market capitalization in the S&P 500 was only 25 times. Recently, it's increased to nearly 30 times, making it more expensive now than in the past. That's the key point. However, other experts argue that it's too early to consider the market as being in bubble territory. Let's hear what evidence they have. There's Nicholas Colas, the co-founder of DataTrek Research. He argues that while valuations do seem high, there are mitigating factors to consider. All right, let's take a look at what he's talking about. When we use Moore's law, which applies to consumer semiconductors, as a proxy indicator, what about computing power? It is said to have increased by about 380,000% since 1999. So what this means is it's to the point where it's incomparable to the dot-com bubble. Recently, as computing power has increased, semiconductor companies and tech companies have seen improvements in technology that allow their profitability and sales to soar. Therefore, compared to the overall stocks in the S&P 500, some tech companies in the Nasdaq 100 are showing much better stock price increases. It's quite natural, and that's how it can be explained. In addition, this year there have been fewer than 20 IPOs related to generative artificial intelligence companies. Meanwhile, in 1999, just before the dot-com bubble burst, there were about 300 internet-related IPOs in a single year. That shows just how heated the atmosphere was. The fact that so much money was going into IPOs means there were a lot of investors putting their money into dreams. We can define this as a bubble, as the hype was growing bigger and bigger. Now, another thing is, unlike the internet craze in the late 1990s, it is argued that when it comes to generative artificial intelligence, there are very few listed companies with real and verifiable profit potential. Only a select few companies truly profit from artificial intelligence, which is a crucial point to consider. In the late 1990s, everyone was using the dot-com name, and there were so many so-called beneficiary stocks. So the investment funds were probably spread out, But now that's not the case. Since there are so few companies running and utilizing generative artificial intelligence, it's only natural that the stock prices of these companies are going up. This means that a foundation is being laid for investment funds to be concentrated. Kohlers also says that in 1999 and 2000, the Federal Reserve was raising interest rates and oil prices were going up. But today it's the opposite. Right now, we're in a cycle where interest rates are being cut, and on top of that, oil prices are actually falling. That implies inflation might also be controlled. So with all this in mind, we can say that even though United States stocks are more expensive than during the dot-com bubble, there is a certain reasonable valuation for them. I think that's how we can sum it up. Now, moving on, I'd like to read one more article today. The title of this article is "A Correction in the United States Stock Market is Imminent." Now let's see what the signs of an imminent correction in the United States stock market are, and if such signs have appeared, what should we as investors do? I'll also share my personal opinion on this. According to the investment firm BTIG, it's time to prepare for a market correction. The market has been running hot for over 3 months, showing an incredible trend with little break. Now it's time to start preparing for a correction. That's how you should see it. That's because the market is sending a few short-term warning signals. Now, first of all, what about the Nasdaq 100 index? As of Sunday, it has continued its upward trend for 60 consecutive trading days without closing below the 20-day moving average. Now, you know the 20-day moving average that we often use? It's a line we look at to check the short-term trend. But in the case of the Nasdaq 100 right now, the stock price has stayed above the 20-day moving average, and it hasn't fallen below it even once for 60 trading days. But just to show you how strong this trend is, the last time the Nasdaq 100 maintained this kind of momentum was back in 1999, right before the dot-com bubble burst. So it's actually a very ominous sign. Jonathan Krinsky, the chief market technician at BTIG, appears. In a report released on Sunday titled "Fasten Your Seatbelts," the Nasdaq 100 index has now gone 60 trading days without closing below its 21-day moving average, which is the second longest streak since 1985. So it's quite rare to maintain an upward trend for this long, which means there's a high possibility that the uptrend will end soon. That's how you should see it. And as I mentioned earlier, there's one ominous aspect. The longest record ended in early 1999, and after that, it went down. Now, but Jonathan Krinsky, he says it's unlikely that this signals a major market top. We can breathe a bit of a sigh of relief now. So it's unlikely that stocks will fall again in a dramatic trend like the dot-com bubble. However, despite that, we could still face some turbulence and corrections. You can view it as a potential short-term correction. What about the warnings? These warnings came as the S&P 500 and the Nasdaq Composite Index started another day at record highs. What that means is stock prices have gone up a lot right now. They hit a new all-time high again yesterday. However, reversal indicators are sending peak signals, and as the seasonal bullish trend weakens, technical analysis has started to suggest that greater volatility may lie ahead. So far, there has been a general bullish trend, right? I've mentioned this several times on the broadcast. July, historically, is a season when stock returns are very strong. So now July is gradually coming to an end. Therefore, a negative trend will likely appear in August, September, and October. BTIG especially added a warning about high-risk assets. I mentioned this a bit on last week's broadcast. Recently, it's not institutional investors, but individual investors who have been driving the upward trend in the United States stock market. And what about individual investors? They really like microcap stocks and growth stocks, so recently there have been some microcap stocks that have gone up a lot. These stocks are high-risk assets, and there's a warning that these high-risk assets could drop sharply. For example, there's the ARK Innovation Exchange Traded Fund managed by ARK Invest with the ticker name ARKK. This exchange traded fund has risen more than 12% just this month. Therefore, recently, these small cap stocks with dreams and hopes and growth stocks showing tremendous growth rates have been rising a lot. What about Krinsky? We thought a correction was imminent over the past few weeks, and we were definitely wrong about ARKK's movement. So we've already said that ARKK will go through a correction. But it still hasn't gone through a correction yet, has it? Nevertheless, the current AIKK stock price is still about 38% above the 100-day moving average. Therefore, except for a short period in July 2020, this is the highest level. Now, when the stock price is excessively above the moving average like this, there is a high possibility that a technical correction will occur soon. Therefore, we continue to believe that a correction is imminent. Now, let me wrap up with a final word from Mijun. As I mentioned several times in early July, statistically, the United States stock market tends to be strong in July. This year, it proved true again. Now, if you also look at the stock market trend from January 1, 2025 until now, I've marked it here in gray. The general trend of the United States stock market since 1928 and the flow during the first term of a new president taking office. This one is purple and it's very similar. Let me show you what I'm talking about. Here, the gray line represents the average value. Usually if you look at this gray line, it keeps going up from January, and then if you see here, it keeps rising until the end of July, and then it starts to slow down a bit from the end of July. It doesn't really move for about 3 months. It moves sideways, staying in a box range, and then from November, it starts to rise again. This summarizes the general trend and tendency of the United States stock market. Let me reiterate the main points. From December to around the end of July, it rises rapidly. Then from the end of July to the end of October, it takes a break for about 3 months. And then for the remaining 2 months, from the end of October to the end of December, it rises again. The purple color seen here has a specific meaning, which I will now explain. It refers to the first year of a new president's term, which is the case now, as it's President Trump's first year in office. Usually, in these cases, the atmosphere isn't good from the end of December to around April. If you look here, it's a box range. It goes up and down, showing a not so good trend, but from around the end of April, it starts to rise rapidly. The stock price rises by a huge margin, but then for about 3 months from the end of July, instead of a box range, it actually falls. Stock prices typically fall during August, September, and October. And then from the end of October through November and December, it recovers again for 2 months. That's what the historical statistics show. So this year is also very similar. If you look at the red line now, it has been dropping since around February. So just like the historical statistics, it dropped once. And from April until now, stocks have been rising rapidly. If the rally that started at the end of April repeats history, it will likely stop again in August, September, or October, or there could be a correction. Then in November and December, it could rise again. That's what we can expect. The last content prepared for today is today's United States stock video. In today's video, the optimist Topney appears once again. I'm sure many of you are already familiar with him. Topney has a very positive outlook on Bitcoin and the overall cryptocurrency market. In fact, he's an investor who has made significant investments in stocks like MicroStrategy. So in this interview, he's predicting that Bitcoin will rise to $1 million per coin within a few years. $1 million is an enormous amount of money. That's about 1.4 billion won. Now let's hear from him about what reasons could make Bitcoin rise to $1 million. Well, that's it for today's broadcast. It was really nice to see you again after such a long time. I'll gather various information that can help with your investment activities and greet you again tomorrow. Let's all keep fighting together until the day we can all retire through investing in United States stocks. Have a happy day. Thank you.
The person who was with you is Tom Lee, head of research at Fundstrat. It probably won't surprise you. He's always said similar things. What he especially emphasized today is that this is the most hated V-shaped rebound he's seen in his career.
That's right. Many investors thought a recession was coming when the tariff bomb exploded in April and the market plummeted, so they liquidated their assets. However, after that, the market showed an unexpected V-shaped rebound, and many people missed the timing. Most people expected a K-shaped recovery or a sideways trend, but the market rebounded quickly. So currently, many investors haven't been able to invest enough, and the news is also being interpreted from a negative perspective. But as you know, corporate earnings have been very solid, and I think that's a positive signal.
The Dow recently hit a high once, but in the most recent session, that wasn't the case. On the other hand, the S&P and Nasdaq are still showing strength. Tom, some people think valuations are becoming burdensome again. Could you explain what the S&P's weighted multiple is, as you mentioned, and what that figure currently looks like?
Yes, this is what we're talking about. Rather than saying the Magnificent Seven are making the market expensive, we should look at the average impact on all the stocks in the S&P 500. In 2019, it was about 17,600 times, and since then, there have been 6 major events: the COVID-19 supply shock, inflation, the Fed's rapid interest rate hikes, Trump's tariffs, and the United States bombing of Iran. Despite those shocks, the profits of S&P companies have grown, and the current equal weight PE is around 16 times. Despite earnings growth over the last 6 years, the market has become more undervalued.
A recent journal article pointed out that even within the MX7, there is a clear difference between companies that actually benefit from artificial intelligence and those that do not. In fact, Apple is currently down about 16%, a 28% drop. In the last year, Apple's stock has fallen, while Microsoft's has increased notably. In this trend, will MX7 continue to be valid, or do we need a new group of leaders?
MX7 has now become a group of names that are almost familiar to the public. Apple is Apple and Google is Google. Everyone knows their products, and they're also well aware of their stocks. They've established a solid position among consumers, businesses, and the overall market. Apple has been quietly preparing for artificial intelligence, and I don't think they need to pay a huge amount for an external model. I think Apple is going to surprise people.
That's a different perspective, isn't it? Many people think that Apple has fallen too far behind in the artificial intelligence race, or that they can no longer attract the talent they once had. That's right.
By the time Apple released the iPhone in 2007, the mobile phone market had already existed for more than 15 years. But the moment Apple entered that market, they completely changed the market itself. So I think that the moment Apple seriously jumps into artificial intelligence, it will also change the game.
In the end, this is the key point. In the past, Apple changed the market by combining hardware and software, but in this era where LLMs and artificial intelligence have become so advanced, the key question is whether they can catch up with their own development or if they need to acquire another company.
Is that right? And another possibility is that LLMs could become so advanced that eventually most of them will reach a similar level. Apple is strong on safety, well known for privacy, and focused on making your life more convenient. And with that, they could release a truly amazing version of artificial intelligence. So I never count Apple out just because they're a little late.
By the way, there have been reports and speculation this weekend that Apple might release its first real foldable phone this fall. What do you think about that? If it really does get released, would you consider buying a foldable phone yourself? Yes, China is a big market for foldable phones. Chinese consumers especially like foldable phones.
Providing someone with a bigger screen isn't just about a simple phone, it's about leading them toward a more powerful computing device. And in the age of artificial intelligence, features like augmented reality may become increasingly necessary. So now might be the right time for foldable phones to become mainstream.
After the passage of the Genius Act last week, should we see you as a stock market expert or a cryptocurrency expert? Are you planning to continue covering both fields, or will you focus on one side?
My goal is to provide good ideas and deliver profits. For example, this year, like the Good Granny Schatz portfolio, we are delivering excellent returns to investors. 70,000.
You predicted that when it was $70,000, it would rise about 60% and reach $120,000, right? You thought that would be possible within a few months, or at least within this year, but now it's almost close to $150,000.
I still think it's possible for Bitcoin to rise to $200,000 or even $250,000. At that level, it's about 25% of the gold market. And considering that it's digital gold, it's possible to go over $1 million in the long term. Especially when you consider policy support like the Genius Act, it's definitely realistic.
Are you planning to recommend investments in stablecoins as well?
Yes, stablecoins are the H and GPT moment of the cryptocurrency market. Both businesses and consumers are adopting them quickly, and major banks like JP Morgan and Citi are also entering the market. It's accelerating even more with the addition of the Genius Act. Circle is also a good choice. But if you really want to invest in stablecoins, Ethereum is ultimately the key. Most stablecoins are created on Ethereum, and more than 30% of the network fees are related to this. If, as Scott Best says, the market size nears $4 trillion, it will be a tremendous opportunity for Ethereum.
Not long ago, it dropped down to $1,700, but now it's risen to around $3,600.
Technically, the target is $5,000, and if it's valued as stablecoin infrastructure like Circle, some believe it could even reach $10,000 to $20,000.
Is August 1st an important day? Do you think something will change this time?
Tariffs are helping the finances, and I think companies are now responding well to them. In fact, these tariffs are quite large in scale, and there isn't much talk about them fueling inflation. That's the half-full glass perspective. As you said, if August 1st is postponed again, that could also be positive for the market.
The beginning is important, so let go of your greed. Grow little by little every day and enjoy today's journey. Even if darkness comes, I'm not afraid. Thank you for retiring with American stocks.